join the meeting.
கேக்குதா? எனக்கு தான் கேட்கலையா?
கேட்கல சார்.
டிஸ்கனெக்ட் ஆயிடுச்சோ எல்லாருக்குமே?
யாருக்குமே கேட்கல மேடம். ஆக்சுவலா எனக்கு கேக்குது.
எனக்கு கேக்குது மேடம்.
நீங்க பேசுனது இப்பதான் கேக்குது.
ஓகே.
Happy morning to all. It's my pleasure to invite each and every one of you for the session this early morning with your busy schedule. Greetings to and warm welcome to the speaker. Thank you, Suresh sir, for accepting our invitation to present a session in the morning hours in spite of your busy schedule. Thank you very much. And this topic is, since it is need of the hour topic, and I hope it will be useful for many of the members because we have a lot of issues in filling up the forms in capital gains. So this will be the right time for us to learn this topic from you. Welcome you, sir. I request Secretary C.A. Venkatesh sir to formally introduce the speaker.
Happy morning to one and all. It's great pleasure for me to introduce our today's speaker, who is going to handle the session on taxation on securities. CA T.G. Suresh completed graduation in commerce from Vivekananda College, Chennai, and qualified as chartered accountant and CMA and company secretary. CA T.G. Suresh is a leading faculty in Chennai in domestic and international taxation, financial management, cost accounting, and financial accounting for close to 30 years. He has been a pioneer and a role model for thousands of students pursuing chartered accountant, CMA, and corporate secretaryship courses. He has produced many rank holders in CMA, CA, CS exams, and produced many CS, CMAs, and CS. He is also a visiting faculty for taxation at the regional councils of the ICA at Chennai, Bangalore, Mysore, Ernakulam, and Cuttack. Many students fondly call him CGS for his exemplary discussion of capital gains. He has been regular faculty RTI Chennai, which conducts training of income tax officials. He is winner of National Award from Capital Foundation Society, New Delhi, from the Union Law Minister. CA T.G. Suresh has also authored books for both academician and professionals. His academic and professional titles include Simplified Approach to Direct Tax Laws, Simplified Approach to Taxation, Capital Gains Tax Law and Practice, Master Guide to Income Tax. He has also written many articles in newsletters of professional bodies, business dailies, and online portals. CA T.G. Suresh has presented papers in various forums on taxation in both professionals and industrial bodies. CA T.G. Suresh is currently chairman of International Fiscal Association, chairman of SICCI Direct Tax Committee. Regarding his professional, CA T.G. Suresh is partner in one of the leading firms in Chennai since 1990. And he has been instrumental in setting up a strong internal control system for his various clients. He has also represented before assessing officers for high-pitched assessments. He has also given opinions of wide-ranging issues in domestic and international taxation to various corporate clients. He has interviewed many CAs, CMAs, CS on technical lines for placing them at various positions in the accounting and financial levels. With these few words, I introduce CA TG Suresh sir before this virtual forum. Now the session is yours, sir. Thank you.
Thank you, sir. Very good morning, one and all. Madam, amidst my schedule, I'm also, but against all times, because against Infosys great portal, அதையும் அதனுடைய சிரமங்களையும் தாண்டி எல்லாரும் இந்த டைப்ல வந்ததுக்கு ஃபர்ஸ்ட் மை தேங்க்ஸ். ஸோ ஸ்பெஷல் தேங்க்ஸ் டு ஷேர் ஃபார் மணிமேகலை மேடம். தேங்க்யூ ஃபார் காலிங் மீ, ரிமெம்பரிங் மீ அண்ட் காலிங். So DC, good morning DC. I cannot say without having seen him, I have to necessarily say good morning to my very good friend, ex-chairman, future chairman, future CCM. So DC, and of course Tamil படத்தோட ஒரு எனக்கு ரொம்ப நாளா சொல்லிட்டு இருக்காங்க சார், தமிழ் ஹிந்தி மல்டி லாங்குவேஜ்ல நடக்கக்கூடிய ஒரு சாரோட அக்கௌண்ட் நீங்க தான் அப்படின்னு கேட்க மாட்டேன்றாரு ஆக்சுவலா. ஸோ மார்னிங் டிசி. ஆக்சுவலா தென்கட்சி சுவாமிநாதன் ரொம்ப ஒரு பியூட்டிஃபுல்லா ஒன்று சொல்லுவார் ஆக்சுவலா. அதாவது சப்போஸ் நான் இன்னைக்கு மேடம் ப்ரொஃபைல் கேட்டுட்டே இருந்தாங்க, ஆக்சுவலா நான் கொடுக்கவே இல்லை. ஆக்சுவலா இன்னைக்கு மார்னிங் தான் அமிச்சேன் நினைக்கிறேன் ஆக்சுவலா. ஸோ நான் கொடுக்கலன்னு சொல்லியிருந்தாக்கா அவங்க வேற மாதிரி சொல்லிருப்பாங்க, டிஜி சுரேஷ் ரிக்வெஸ்ட் நோ இன்ட்ரடக்ஷன் அப்படின்னு சொல்லியிருந்திருப்பாங்க ஆக்சுவலா. கொடுத்ததுனால வெங்கடேஷ் சார் ரொம்ப கைண்ட் ஆக்சுவலா வித் திஸ் ஃபியூ வேர்ட்ஸ் அப்படின்னாரு. ஆக்சுவலா நிறைய என்னை பத்தி நிறைய சொன்னார் ஆக்சுவலா. அது இது நான் இதை ஐ வாண்ட் திஸ் கிரெடிட் டு கிவன் டு தென்கட்சி சுவாமிநாதன். செம்ம ஒன் ஆஃப் தி மோஸ்ட் சிம்பிள் அண்ட் பியூட்டிஃபுல் ஐ திங்க் ஆல் ஆஃப் அஸ் டுடே கேன் லிசன் டு இட். அவர் என்ன சொல்லுவாருன்னா ஆக்சுவலா சார் என்னை பத்தி ரொம்ப பிரமாதமா சொன்னாங்க நிறைய விஷயம் ஆக்சுவலா. இது ஆக்சுவலா நான் எழுதி கொடுத்ததுதான் ஆக்சுவலா, ஆனா இவன் முழுக்கவே சொல்லுவானா உனக்கு கொஞ்சம் 4 பேஜ் எழுதி கொடுத்துருப்பேன் அப்படிப்பாரு ஆக்சுவலா. தேங்க்யூ வெங்கடேஷ் சார் ஃபார் திஸ் வண்டர்ஃபுல் இன்ட்ரோடக்ஷன். அண்ட் மேடம் சொன்ன ஐ திங்க் திஸ் இஸ் தி 3rd program in a span of 10 days on shares and securities actually. So that clearly shows that எல்லாருக்குமே இது ஒரு ரிக்வயர்மெண்டா இருக்கு ஆக்சுவலா. பட் அதர் 2 programs அட்லீஸ்ட் ரெக்கார்ட் பண்ண மாதிரி தெரியல ஆக்சுவலா. அதனால ஃபியூ ஸ்லைட்ஸ் ஐ மே ஹேவ் டு skip in today's discussion, which maybe I can take it out of this thing for a different reason. So அது definitely any members who have some questions on that or some understanding of that, we will definitely offhand அதை நம்ம எடுத்துக்கலாம் ஆக்சுவலா. So it's a very subtopic relating to that. மெயினா I think இந்த டாபிக் இவ்வளோ பாப்புலர் ஆனதுக்கு பார்த்தீங்கன்னா பாம்பே எல்லாம் பார்த்தீங்கன்னா அது ரொம்ப ரெகுலரா இருக்கும் எப்பவுமே இந்த ப்ரோக்ராம்ஸ். பாம்பே குஜராத்லாம் பட் இன் தமிழ்நாடு ஆர் எனி அதர் பிளேஸ் இன்னைக்கு பார்த்தீங்கன்னா இது ரொம்ப Tier 2 Tier 3 சிட்டிஸ்லுமே எல்லா சிட்டிஸ்லுமே இது வந்ததுக்கு ஒரு காரணம் இந்த லாஸ்ட் 2 years ஆஃப் கோவிடுக்கு ஒரு சில நன்றிகள் நம்ம சொல்லலாம் ஆக்சுவலா. ஸோ ஒன் இஸ் லைக் டெஃபினெட்லி சிட்டிங் ஃப்ரம் சென்னை ஐ எம் ஏபிள் டு அட்ரஸ் பீப்புள் ஃப்ரம் மதுரை. And one thing is that the number of demat accounts opened for the first time in the last 18 months, June மாசம் மட்டும் தான் கொஞ்சம் குறைந்திருக்கு. அதுவே மில்லியன்ஸ்ல இருக்கு. But still that shows definitely in this period of time a lot of people have started looking at an alternative investment. More traditionally we used to put it in fixed deposits, adile nambo bank leye potirkom actually. But a very, very strong capital market is very important. Sometimes எப்பவுமே பாத்தீங்கன்னா circumstances is mother of invention அப்படின்னு சொல்லுவாங்க. I think the circumstance of COVID has definitely brought many people to shares and securities. A robust capital market is always very, very good. Maybe நீங்க பாத்தீங்கன்னா நேத்திக்கு ஒரு இன்ட்ரெஸ்டிங் இன்ஃபர்மேஷன் பாத்தீங்கன்னா the PFல they are going to increase the investment in equity from 15% to 20%. Which means there's going to be a huge money is going to come into the stock market, which is good because at the end of the day, if I had to give 8.5% tax-free return to PF, naturally they have to the investment. I cannot put in 6% give 8.5%. Actually, so I think definitely the government is moving towards that. Retail participation is fantastic. So definitely for some more time. Sure, this will be there with more and more youngsters and more people joining this, and the more and more could be the tax implications. See, எல்லாத்தையும் மீறி நம்ம ஆக்சுவலா பாத்தீங்கன்னா அந்த AS we have to appreciate because last time நிறைய ரொம்ப இன்ட்ரெஸ்டிங்கா ஒரு கிளைண்ட் வந்து சொன்னாரு, சார் நீங்க நிறைய ஷேர்ஸ் எல்லாம் வச்சிருக்கீங்க அப்படின்னு சொன்னப்போ அவர் வந்து, ஹலோ கேக்குதா?
கேக்குது சார், கேக்குது சார்.
சார் ஆடிபிள் சார், ஆடிபிள் சார்.
ஹலோ
சார் ஆடிபிள் சார்.
ஷேர்ஸ்லாம் நீங்க வச்சிருக்கீங்க, அதோட டீட்டெயில்ஸ் வேணும் அப்படின்னு கேட்டப்போ அவர் வந்து, இல்லை சார் ஷேர்ஸ்லாம் நான் விற்கவே இல்லை சார், அதெல்லாம் ஒன்றும் பண்ணவே இல்லை அப்படின்னாரு. ஆக்சுவலா சரி சார் ஒன்றும் இல்லை, உங்க இந்த மாதிரி ஷேர்ஸ் வித்த பத்தி ஒரு இன்ஃபர்மேஷன்லாம் வந்திருக்கு, அந்த இடத்துல போய் நாங்க போய் சொல்லிடுறோம் இது உங்களுது இல்லைன்னு சொல்லிடுறோம் அப்படின்னு சொன்னா போறோம். இல்லைன்னா நீங்க இப்படி ஃபைல் பண்ணிட்டோம்னா அவங்க கொஸ்டின் கேட்பாங்க நாளைக்கே அப்படின்னு உடனே, சார் ஒரே நிமிஷம் உடனே எங்க அப்பாட்ட நான் கேட்டு சொல்லட்டுமா, அவருக்கே 40 வயசு ஆகுது, எங்க அப்பாட்ட போய் நான் கேட்டு சொல்லட்டுமா அப்படின்னு. எங்க அப்பாவுக்கு யாருமா இல்லை சார், நீங்க டக்குன்னு சொல்லிடுங்க, ஒண்ணு நம்ம ரிட்டர்ன் ஃபைல் பண்ணுவோம் இல்லைன்னு நான் சொல்லுவோம். அப்புறம் பார்த்தா அடுத்த நாள் வந்து இவருக்கு 40 இயர்ஸ், இவர் சொல்றாரு எனக்கு தெரியாம ஆக்சுவலா எங்க அப்பா இன்வெஸ்ட் பண்ணிட்டாரு அப்படின்ற போல. தென் சப்சிக்வென்ட்லி, ஸோ தேர்ஃபோர் lot of undisclosed this thing. I think we must thank the AS for many people actually showing for the first time many capital gains and dividend income and all. So it's a really interesting one. I definitely, not from the client's point of view we should look at, and I also definitely wherever possible definitely we as a professionals with our fantastic knowledge, what separates a chartered accountant from others, we have a sound knowledge in accounting, finance, costing and tax. அந்த 4 இன்கிரிடியன்ஸ் சேர்த்து ஒரு நாலேஜ் இருக்கும்போது ஷேர் மார்க்கெட்ல டெஃபினட்டா the chances of losing whatever be the whether the market goes up goes down doesn't matter actually. With this much of knowledge, I'm sure that so we can definitely beat the inflation substantially. That is my experience, and I can surely with your knowledge I'm sure all of you will be already doing it also. Whether the market goes up or goes down, we have the knowledge and bandwidth to definitely create wealth and income for every one of us. And Shora adiyum beyond clients, I think we should also, for individual also, we can look at this, my humble request this point of time. So definitely it is not like you're gambling and all. It's definitely something which Rakesh Junjunwala himself is a chartered accountant. If he's a Warren Buffet of India, the definitely or a chartered accountancy knowledge, I don't have any other doubts. His ability to pick up stocks and other things, I'm sure all of you can do wonderfully. But of course, today's session is more going to be confined to the tax implications of the shares. So to ensure that, in fact, இது இப்போ வந்து நான் ஸ்டாண்டர்டா வச்ச மாதிரி வச்சுக்க ஆக்சுவலா. இன்ஃபேக்ட் கும்பகோணத்துல வந்து அவங்க சொன்னாங்க, ஆக்சுவலா சார் காலங்காலத்துல காஃபில ஆவிலாம் கூட வந்து சார் செம்மையா இருந்துச்சு சார் அப்படின்னு. ஆக்சுவலா ஸோ சின்ஸ் இட் இஸ் வர்ச்சுவல் சீக்கிரம் இருக்கும்போது ஆக்சுவலாக நம்ம காஃபி சாப்பிட்றோம். ஸோ இப்போ இருந்தனால ஸோ த டாபிக் இஸ் ஷார்ட், ஸோ டஸ் தி பிக்சர் ரெப்ரசென்டிங் தட் ஆல்சோ. So any questions at any point of time, so please feel free to ask that question. So I'll be more than happy. We don't have to wait for the program to come to an end. By the time program முடியும்போது 2 விஷயம் இருக்கும். ஒன்று நமக்கு கொஷின் மறந்து போயிடும், 2வது லஞ்ச் டைம் வந்துடும். அப்போ ஆக்சுவலாக இந்த ஒரு 1-1.25 வரும்போது, ஸோ அதனால இப்போ மிஸ் பண்ணிட்டோம். அப்பப்போ நம்ம ஏதாவது கொஷின் தான் நம்ம க்ளோஸ் பண்ணிட்டு போயிடலாம் அப்படி ஆக்சுவலாக. ஸோ பேசிக்கலி வாட் I have decided to cover is like overview of the provision relating to shares, of course, definitely including futures and options related issues also. So there is a special provision in Income Tax Act which was introduced by this Finance Act of 2022 for curbing the practice of bonus stripping. Business income or capital gains, it's a debatable issue. I'll just find out whether to have or not, but at least I'll leave the PowerPoint so that you can have a look at it. So some of the other issues we'll try to catch up, and also of course if I have any questions I will happy to take it in between. So basically on the overview of provisions relating to shares, so what I want to first cover here is the meaning of short-term capital asset, because relating to shares and securities, there are quite a lot of changes have taken place. cost of acquisition relating to shares and securities, the provisions relating to set off and carry forward of losses, tax rates relating to short-term capital gains, so bonus stripping and dividend stripping, and how bonus stripping has been attempted to be curbed in this Finance Act of 2022. May not be for the last assessment year for which we are filing the tax returns, but for the next year, there is a necessity for us to take into account this particular aspect of it, because there could be losses, but we may not be in a position to set off and carry forward of losses arising out of bonus shares on account of this particular change introduced by Finance Act of 2022. Dividend stripping, I think that has lost its relevance today on account of the dividend no longer being exempt from tax. This is provisions relating to shares. I will also try to take you during the course of discussion how these sections got evolved so that we are in a position to appreciate the whole discussion better. So because sometimes as we all been discussing before the start of the session, so the deep reading is something which has to return. Whenever we take a provision, so it has to be read pretty deeply. I'll make an attempt for that deep reading by going from what is the backdrop, where they change and how the changes evolved over a period of time. Sometimes it could also go back to even 30 years also. So basically the short term or long term relating to shares, in fact, it has been something which is pretty, I'm very surprised. In fact, in my book on capital gains, I've also recommended this, that the holding period for all assets can be either 12 months or 24 months or 36 months. Let it be anything. Let us not try to have a situation where for some assets it's 12 months, some assets 24 months, some assets 36 months. See, when we are trying to go into a more faceless scheme of things, when we want to go into a system where we want to reduce the interface, then in those circumstances, it is better we have a more simpler system. We should not have a very, very complicated system, which becomes pretty difficult to understand by the people, by the system. And especially when we are trying to make use of the artificial intelligence and machine learning and all the stuff, I think definitely it's very important in those circumstances we have a more simplified version. But right now, we'll talk about what are the existing revisions. So up to assessment year 2014-15, just to give you a little bit of a background how things have changed so that we can appreciate this a little bit better. So till 14-15, shares, all shares, whether it is private limited, public limited, whether it is listed, unlisted, preference, no preference, not a problem. They had a very simple system of only 12 months to become long-term. So the definition of long-term capital asset is very simple, one which is not a short-term capital asset. So that's a very simple definition. Short-term capital asset is what we have to look into, because short-term capital asset is defined by section 242A. So there are three categories, but we are focusing only on the shares part of it. Up to assessment year 14-15, shares, listed securities, zero coupon bonds, all of them came under the category of 12 months. And again, we also had the mutual funds coming under that category. So units, shares, listed securities, zero coupon bonds. These four were under 12 months category. In his very first budget, the former finance minister, one of wonderful human being, Mr. Arun Shetty, made a very interesting change from assessment of 15-16. So where for the first time, instead of shares, he brought listed securities. So for the 12 months category, shares was removed, only it was listed securities. Units of equity oriented fund, as against all units, only units of equity oriented fund. Then zero coupon bonds. I'll remove the zero coupon. So we had listed securities and units of an equity oriented fund, where an equity oriented fund means 65% of the amount raised in a particular scheme has to be invested in the shares of domestic companies. So what happened as a result of it? Unlisted shares or shares other than listed went into the category of 36 months for two assessment tests, 15-16 and 16-17. Again in 17-18, shares other than listed were brought under the category of 24 months, shares other than listed. So what is very important, when they brought unlisted shares, they did not say unlisted securities. They only said unlisted shares other than quoted shares or other than listed. So therefore, an unlisted debentures will go to 36 months, not under 24 months, because the 24 months was only made open to shares alone. Of course, subsequently from assessment in 18-19, that was extended to land or building also. So therefore, look at the confusion here on the basis of these changes, which I try to put it in a simple single slide. Listed shares, no problem. Whether it is 14-15 or 17-18 or 22-23, no issues, 12 months. But take the case of shares which are not listed. 14-15, 12 months. 15-16 and 16-17, 36 months. And from 17-18 onwards, it is 24 months. Though we might think that 15-16 is far off, of course, but for some reason, our case is taken up for 147. This will be definitely of some help. Because, so what we are trying to do is not only for the current year, and we are also doing for earlier years because of income escaping assessment and so on and so forth. So this is a very interesting part of it. So units of equity oriented fund listed shares, not a problem. Through their 12 months. But take the case of units other than equity oriented funds, which my articles always get confused. So it's 12 months for assessment of 14-15, but 15-16 onwards, it is 36 months. And for some very strange reason, my articles, what they will do is for debt funds, they don't index. The indexation is prohibited under the third proviso of section 48, only for debentures or bonds other than capital index bonds issued by the government of India. So debt funds, if it is held for more than 36 months, you can index it. There's no problem at all. So this is a very, very interesting point, because even the 12, 24, 36, even the revenue secretary made a statement after this budget. Said like he wanted professionals to come back with a comparative study of capital gains across countries in the developed countries, come back so that we can have a complete relook at the capital gains chapter. So that means even government is actually concerned about these complexities, and they also want to work out a more simplified version based on the best lines of internationally how it works out. And also, I remember the former finance minister from Tamil Nadu, he also mentioned, I am not able to understand why it is 12, why it is 24%, why is 36. We should bring some uniformity, but unfortunately, he didn't bring us a different story, but it was there in the mind. So therefore, this confusion, the government is seized of this matter. They want to simplify. I think definitely we as a professional body, we can also come back and try to come with some kind of suggestion to the government on this particular point, so that the capital gains becomes a lot more simpler. So, so on the short term, long term itself, this is the amount of confusion we have. For shares, we have to be slightly careful, especially mutual funds. A lot of confusions are there. So one other interesting point, in one of our cases, our assessee had listed shares in a foreign country. The shares are not listed in India. For example, if you take a case of some of the companies in India, which are very prominent, like Cognizant or CP Technologies, they are not listed in Indian brokers, but they're listed in New York Stock Exchange, or they're listed outside India. Some of them listed in Singapore, some of them listed in US. So though they are not listed in Indian bourses, though they are Indian company not listed in Indian bourses, but they are still listed outside India. So where do you put them? This is one confusion our articles had. Sir, the 12 months, 24 months, 36 months, will it be 12 months? But if you go to the definition of listed shares, they very clearly specified listed shares means shares which are listed in stock exchange in India. So therefore, if your shares are not listed in Indian stock exchange of either the National Stock Exchange or Bombay Stock Exchange, the question of taking 12 months does not arise. So does it then means 36 months. So again, if you look at the second category, it says shares other than listed shares, where the listed shares has been defined as shares listed in stock exchanges in India. So therefore, from 1718, if the shares are listed outside India, then they will come under 24 months and not under 36 months. So therefore, for listed shares in India, no problem. Across 12 months, if the shares are not listed in India, 14, 15, 12 months, 15, 16, 16, 17, 36 months, and 17, 18, 24 months. I'm just saying on one particular point of whether 12 or 24 or 36 relating to shares, we have so much of issues relating out of it. These are all some of the questions during the course of filing of return the last 2 years asked my people, because as rightly said, as we organized the program the last 2 years, the number of demat accounts have gone up, number of transaction shares have gone up. Added to that, AS has also come, so where definitely a lot of reporting of the transaction takes place, and definitely that is one of the reasons why. So we need to carefully understand and analyze these particular points. In one of the cases, one of my client had a very peculiar problem. He sold the shares exactly. Let's take, for example, the third bullet point in this particular slide. So he purchased on 1st May 2021, just for the sake of example, and he sold the same on 1st May 2022. Now, whether this capital gains, should it be considered as a short-term or long-term? So what is 229WA saying? Now, 229WA says, if a long-term capital, very simple, one which is not a short-term capital. So if you go to 242A, it simply specifies, in the case of 242A, it says held for not more than 12 months. Or in the case of unlisted shares, not more than 24 months. So that means if it is held for not more than 12 months, it is a short-term capital. So to become a long-term capital asset, therefore it has to be held for more than 24 months. So here, if I take into account 1st May 2022, then in those circumstances, it becomes more than 24 months. But if I should not consider 1st May 2022 being the date of sale, so look from the point of view of the department, they may have a very valid point here. See, you purchase shares on 1st May 2021. You want to include 1st May 2021 being the date of purchase as a part of your holding period. So that means if you are selling on 1st May 2022, somebody should be buying from you on 1st May 2022. He is going to take 1st May 2022 for calculation of short-term, long-term by him. Yeah, so 1st May 2022, somebody is going to buy, he is going to take 1st May 2022. So if the buyer is going to take the date of purchase as 1st May 2022, and you as a seller cannot take, because both buyer and seller cannot be said to be owning the shares on the same day. So therefore, more than 12 months or 24 months means you should sell only on 2nd May 2022. Then only it becomes long-term. This is the department's contention. But whereas from the point of view of SSC, obviously if it becomes a long-term, the one is getting exposed to exemptions under section 54 EC earlier. Now only 54F. Earlier you will get the benefit of both 54 DC and F. Plus, of course, if the capital gains is long-term into the listed shares, he is going to only pay a 10% tax in excess of 1 lakh. Whereas if it's a short-term capital gains, he has to pay 15% tax without any this thing. Even if it is 10,000 rupees, you have to pay 15% tax. So apart from what we have as the benefit of reinvestment options available, we also the tax rates are lesser. So the one contention here, look at what this 242 is saying. The asset should be held for not more than 12 months. It is not saying he should hold for 12 months plus 1 day. That is not there at all. So what is more than 12 months? 12 months plus 1 minute also, it is more than 12 months only. For example, on 1st May 2022, even assuming for a moment I sell the shares in the stock exchange and the market opened at 9:15, I have held these shares for 12 months, 9 hours, 15 minutes. 12 months, 9 hours, 15 minutes, which is more than 12 months. Right. So therefore, so in this particular case, when the law does not say, so that more than 12 months has to be a full day, then I take it as a long term. It's a question. So of course, the Delhi High Court took a stand that even the asset is sold on 1st May 2022, the capital gains will be only long term because of the fact the law does not say that more than 12 months has to be in terms of a completed number of days as such. Even if it's at 12-1, I've held it for more than 12 months. So therefore, for some reason, see, very honestly, I think most of the clients don't try to plan this and all, despite the fact that there are some fintechs companies which are in brokerage, which are low brokerage firms, to beautifully give that, okay, you have another 15 days to go for long term, all this data and statistics they try to give. So that they definitely are fantastic suggestions they give in the buy illiquid stocks, or when you just try to make an investment. There are quite a lot of suggestions are actually being made. I think technology is coming to help, but most of the time, people's buy or sell becomes more emotional, and therefore suddenly one fine morning when the previous day the price falls and they're already sitting with some profit, the next day they are scared. Will it fall another 10%? Therefore, I will sell. You don't even find out whether it is short term, long term, whether we are only 1 or 2 days away. So most of the time, the purchase or sale happens in such an emotional manner. That's where these kind of things happen. But in those circumstances, definitely the answer is the capital gains will be considered as long term only. To put it in a more simple language, include both date of purchase and date of sale for the calculation of short term or long term, which is very, very important, especially when one common mistake I noticed in our office, especially while calculation of depreciation. So what they will try to do, they will put the date of purchase and they will keep 31st March 2022 and date of acquisition. In Excel, they will try to subtract this number. So suppose if it is purchased on say 4th October, so the difference between 4th October and 31st March is what Excel will give. So that means you are calculating 1 day short. So it is better either you put 1st April 2022 when you try to automate, or if you keep 31st March 20, make +1. Same thing here. If you put 1st May, and then take the difference and try to work out, still the system might calculate it as not more than 12 months. So therefore, it's very important that we try to take +1 or suitably make the modification, the Excel automation, so that this is correctly captured. So that is a very interesting point on short term and long term. So on the cost of acquisition, we have a couple of sections, 55(2)AA and 55(2)AC relating to shares and securities. We'll just quickly run through this before we take up that. I think these are the areas which we'll consider. It's a very interesting changes have been made in 55(2)AA in 2 assessment years, 95-96 and 96-97. So this is in contrast with what we have learned in accounting, more particularly accounting standard 13, which deals with the accounting for investments. When buy the original shares and they also get the bonus shares, the cost of acquisition so is considered on the basis of average cost. To put it differently, the bonus shares cost is arrived by dividing the original cost with bonus shares plus the original shares. So essentially, to put it differently, so we arrive at the cost by considering the actual average cost as the cost for both original and bonus shares. Just to give a small example, recently, possibly some of you might have seen, IOC came out with a bonus issue in the rate of 1:2. And if assuming I purchased 3,000 shares at 110 on 29th of June, this is what I would have paid. So I would have got 1,000 shares as a bonus. So typically what we try to do in accounting to arrive at the cost of acquisition, so effectively this becomes your cost of acquisition of both original and bonus shares. So it's not a zero cost, and there's not 110 for original shares. So both original and bonus shares are averaged out by you taking the cost of acquisition is 82.50. This was also been accepted in income tax before the amendment was introduced in assessment year 95-96 and 96-97 by then Finance Minister Mr. Manmohan Singh. So we changed the provisions. So as far as income tax is concerned, for the 3,000 shares, we'll take the cost of acquisition as 110. And for the 1,000 bonus shares, the cost will be taken as 0. So this is something which we need to understand. In fact, the Finance Minister at that point of time also mentioned this changes are made for the benefit of the SSC. That's a very interesting point, and in fact, it is to be considered as a bit of a benefit because here, if we are trying to take advantage of the bonus issue and by just before the bonus issue record date, for example, in the case of IOC, the record date is 30th of June. Somebody wants to take advantage of the bonus shares buys on 29th of June and then gets the bonus shares, right? But there could be some shareholders who may be already having IOC. For example, somebody has got the IOC shares from 1/4/2001. So if he is holding the shares from 1/4/2001, and just for the sake of simplicity, don't try to take the exact numbers and all. We're just trying to, for illustration purposes, just for the sake of simplicity, we'll assume it is same 110. Just for the sake of easy understanding only. Let us not get into what is the actual price and all. Just we'll try to simplify. So now he is now going to get bonus shares in financial year 22-23. He will get 1,000 shares. So the formula given by 55(2)AA or before the introduction of 55(2)AA does not differentiate between did you acquire the bonus shares, original shares just before the bonus or not, right? In any case, they will always apply the principle of the average cost. Now, the problem for me taking account this number which you already produced in the base of the average cost. So the current provisions of Income Tax Act wants you to take like this. If they not amended the law, the problem here will be for me the original shares cost would have become 247,500. So whereas the bonus shares cost would have become 83,000 or 82,500. Or when both original shares and bonus shares happen the same year, I don't have a problem. But if they happen in a different year, any dilution of my original cost is going to have a huge impact, as all of us know. In the case of a long-term capital gains, forget about except where 112A is going to be applied. We still get the benefit of indexation unless 112A becomes applicable. So any dilution of my original cost here, though I may have the same number, but 247,500 into 3.31 is a benefit you're going to get. That's why I took an example of 2001 too, because the base number is 100 for easy understanding. So that means though the cost is averaged out due to the concept of indexation, I am going to lose the benefit on account of the decision of Supreme Court in Dalmia investment, where the Supreme Court, following the accounting principles, said the cost of acquisition of bonus shares should be arrived by spreading the original cost with both original and bonus shares. Of course, some professionals would have taken some very interesting stand, which will definitely to overcome this problem. Some of them even took a stand. The index cost of acquisition should be averaged out. So some novelty were tried. I think we must give the credit to Mr. Manmohan Singh. What he said was, okay, let's try to make the law simpler. I understand what you're coming back and saying. The original shares will remain as the original cost. Bonus shares will have a zero cost. So therefore, irrespective of when he acquired, whether current year or earlier years, to get the benefit of indexation wherever you're eligible, let us keep the original cost as original cost, bonus share zero. So once the original shares is freezed as the original cost, the same principle will also apply for rights issue. So in the case of a rights issue, so normally the price at which the rights issue is going to come out, which is definitely going to be much lesser than the price. So if you take a classic example of City Union Bank, when they came out to the rights issue price was 21, but at that point after the market price was 45. So again, State Bank, when they came out of the rights issue, the price was 240 and price was close to 600 here in 2008 when they came out of the rights issue. It was a huge gap. I still remember at that point of time, the chairman of State Bank of India, Mr. O.P. Bhatt, said, at this price of rights issue, it is a steal. That's what the words used. But of course, suddenly due to Lehman crisis, on the final day, suddenly the rights issue price in the market was almost closer. There was a bit of a scare whether the rights issue will be also through. But of course, that is beyond the control. So we can cite a lot of examples. The Federal Bank is 240 when they rights issue price was 300. So a lot of example you can find. There is a big gap between original and rights shares. Though a lot of people come back and say that if the rights issue is not given at a discounted price, who will buy? But the real reason is post rights issue, there is going to be a dilution in the earnings per share, since the market price per share is a function of the EPS into the price earning multiple. So any fall in the market price post the rights issue will automatically have an impact on the market price per share, because there is going to be a dilution on account of the fresh issue of shares. The impact of it reflecting the earnings could take some time. So therefore, the market price per share of most of the companies will fall after the rights issue. So this has been recognized in accounting also, where the cost of the rights renunciation, if I choose to renounce the rights, the fall in the market price of the shares is going to be taken as the cost of acquisition. The view of it has also been accepted by the Supreme Court in Dundara by Kapatia, where Supreme Court accepted this particular point, where the fall in the market price of the original shares will be taken as the cost of acquisition of rights renunciation. If the professional sitting here, if you find this discussion of the last 5-10 minutes to be complicated, you can assume what will be the position of many assessees as well as the department officials. I think that's where, because it needs a lot of expertise in the financial management to understand this concept. And we must complement the Apex Court also at understanding the financial management principles, accepted this in taxation also in absence of the provisions to the contrary. So that is where Mr. Manmohan Singh introduced 55(2)AA. So where he said the cost of acquisition of original shares will stay put, it will remain as the original cost. Bonus share zero, right shares will have the price for the rights issue. Whatever be the amount you paid for the rights issue will be taken as rights, provided you subscribe the rights issue. In case if you renounce the rights issue, there are two people are going to be involved in the transaction. One is the renouncer and another one is the renouncee. The renouncer will have nil cost. The accounting principle of fall in the market value of the original shares will not be applied. Instead, the cost of acquisition is going to be taken as zero. That means entire consideration accruing to him will become a short-term capital gains. Whereas from the point of view of the renouncee, when he pays the renouncer, he does not get the shares, he gets only the right. Plus, he should also pay the company or the institution the rights issue price, then only he can get the shares. Therefore, the cost for him will be the amount paid to the renouncer plus amount paid to the company. For example, 21 rupees is the rights issue price, and assuming I already have City Union Bank shares, which I don't want to subscribe, I sell my right, say for 10 rupees. For me, the entire 10 will become short-term capital gains. Whereas for the person taking rights from me on my renunciation, he has to pay 10 rupees to me. Plus, he should also pay 21 rupees to the City Union Bank. So total cost of acquisition for him will be 31. But for calculating short-term or long-term, you will only consider it from the date of allotment of the rights issue and date of allotment of the bonus issue, which I've kept in the slide as the last part of it. Renunciation. Rights renunciation will always be considered as a short-term capital gains because no company is going to keep open the rights issue for more than 12 months, even if it is a listed shares. If they keep open a rights issue for more than 12 months, I'm sure it is not a right issue. It is actually a wrong issue. Otherwise, why it's not going to get subscribed for that long? But even if they renounce the subscribe for the shares, you take only from the date of allotment of the rights issue or bonus issue, as the case may be. So one very interesting point here, as far as how do you consider this in the case of shares which are in the demat account, you apply first in first out method, because under the dematerialized form you don't have the share certificates. In the case of private limited company, even today we give a distinctive certificate numbers, which is not going to be the case in the case of the listed securities on account of dematerialization of shares. Therefore, first in first out method is to be followed for the purposes of arriving at that. So therefore, in the order in which it is dematerialized, the first shares will be assumed to be sold first. So if you sell both original and bonus shares, first it will be considered as a sale of original shares first, because that is going to be first in your demat account. But one interesting point here is that whether fair market values on 1,4,001 can be opted as the cost of acquisition. So because 55, say, especially if you take the case of a bonus shares, the cost of bonus shares is 0. What if I got the bonus shares prior to 1,4,2001? Should I have to take it as a 0, being a specific provision says the cost is 0, or can I substitute FME on 1,4,2001 under section 55, subsection 2, clause B? So obviously, even recently, the department tried to apply the cost of acquisition 0, stating that 55(2)AA says the cost is 0, therefore should be taken as care. The question of substitution does not arise. But what has been missed out, in my view, by the department here is that 55(2)AA starts with subject to 55(2)B, subject to 55 subsection 2 clause B. The cost of acquisition should be taken as 0. So, but what is 55(2)B? If you have acquired the shares prior to 1,4,2001, you are entitled to substitute fair market value as on 1,4,2001. So, therefore, the substitution of 1,4,2001 is available for original, bonus, rights issue, for everything you have the option of substituting, though the cost is 0 because of this specific provision. So, by virtue of the general provision, you can still apply because the specific provision has been made subject to the general provision. So therefore, 55(2)B will still override the provisions of 55(2)AA. So one last section relating to the cost of acquisition before we take up some interesting points here. So I thought we can refresh the various provision relating to shares before we proceed further. 55(2)AC has to be introduced consequent to the omission of section 1038. So 1038 provides for exemption from capital gains on sale of listed shares. So that was actually removed. It was introduced, most of you will be aware of, it was introduced from 1st October 2004, consequent to introduction of security transaction tax for STT. Interestingly, in 2004, before 1038, we also had section 10 subsection 36. In 1036, exemption for listed shares were provided even if you don't pay STT. There's no need to pay STT at all. I just wanted to find out how things have evolved. 1036 was saying listed shares, no capital gains tax if you sell after 12 months. In fact, Mr. Jashwant Singh was the finance minister at that point of time, specifically told that if we come back to power, we will continue with this provision of 1036. That was is very important observation. 2004. So he said, I introduced update 22. Well, when I come back, I will extend the section. Unfortunately, they did not come back to the power. When the new government came, they modified 1036, brought it in the name of 1038, along with section 1037, which provides for exemption for compulsory acquisition of urban agricultural land. 1038 specifically provided if you are going to pay security transaction tax under chapter 7 of the Finance Act, so then upfront you pay like a turnover tax, and if you paid that tax, then if the capital gains is short term, you have to only pay 15% tax, and if it is long term, you don't have to pay tax. So interestingly, for the benefit of some of you already know, for the benefit of some of you not aware of it, when 111 was introduced, the rate of tax was only 10%. This was only 10%. Why it is 10%? The reason for the 10% is because that's the first slab rate at that point of time. So because they say we'll charge you at a concessional rate of tax. The first slab rate of tax when 1038 was introduced on 1st October 2000 was 10%. Therefore, 111A, which is there for short-term capital gains, provided for tax of only 10% when it's introduced. Now, of course, they made it as a 15% with a very interesting analogy. A very interesting analogy. I'll just take a minute's time out of it. Of course, if it is a long-term capital gains under 1038, it will be exempt from tax. The only point was subsequently 1032 was changed to specifically provide that you should have paid STT both at the time of purchase and sale, whereas in 111, even today, you had to pay STT only at the time of sale. It is not necessary you should pay at the time of acquisition. Whereas both for 112A and for 1038, the STT is required to be paid both at the time of acquisition and also at the time of sale, subject to certain exceptions provided through the court circular, which I'm not going to get into. Now, the very interestingly, this 10% was made to 15% by a very different logic. The real logic, where they want to garner more revenue. That's all simple as that. But they just want to defend that because when they introduced, they said this is a concession. I'm using first slab rate of tax. Therefore, they just to defend it, they say that a company either retains profits or distributes profits. When it retains profits, it wants to invest somewhere else, and thereby they want to increase your earnings per share. And once your earnings per share is increased, automatically you are rewarded by way of enhanced market price per share. So that means the retention will increase your capital gains, and in case if it is a distribution, it will be subject to tax as a dividends. So therefore, basically, the company has to either reward the shareholders by distributing by way of a dividends, or alternatively retain it, invest in projects, increase the earnings, increase your market price per share, reward you as a capital gains. That is from Mr. Garden, who explained his theory of dividend model. He will always come back and say a shareholder will always prefer a bird in hand than two in the bush. That's why always he will defend the concept of a dividend. Always you prefer a dividend today to a capital gains tomorrow. That is what the famous Gardens model of D1 by P0 plus G, however the cost of equity. It's a very interesting model by itself. So he said the dividends under 115O, because today 115O is also not there. Dividend distribution tax, as you just recall, it's also at 15%. So when the dividends are taxed at 15%, the capital gain should also be taxed at 15%, was the logic given for increasing from 10% to 15%. So you bring in law to amend what is financial management saying. You bring the law in line with financial management. So there is a contradiction here. So when it suits, you want to apply a FM. You don't want to do it. That's a very interesting. We should have been consistent when you try to apply the concept of financial management tax. You have to be consistent. You cannot have a situation where for bonus shares and this thing, I will adopt something different. For this thing, I will adopt different. But area be whatever be the case, that is a law. So now suddenly they took a decision to abolish 1038, but unfortunately, 1038 was introduced only because there was an STT. So once you decide to bring long-term capital gains to tax, obviously security transaction tax should not be there. I don't think it is right to collect both turnover tax and capital gains tax. You choose one of them. That once the exemption was given at 1038 or a concession rate of tax is given only at the pretext of there is an upfront tax collected. Please understand 1038 or 111A was not free. Let us not get the mistake of it. 111A or 15% tax or 10% tax not as initiated is because upfront we are collecting by way of an STT. Long-term capital gains was exempt from tax, not because I want to exempt. I am already having a upfront, I'm collecting the tax by way of STT. But when 1030 was removed, unfortunately, security transaction tax was also not removed. So today you have both STT as well as a long-term capital gains tax, and we also have 111A also. So that means essentially there is a double taxation different. Now, but however, when you remove 1038, all of us know earlier the budget was presented on 28th of February. Now the presentation of budget happens on 1st of February. So if you bring this proposal in February and March, there will be a huge exodus in the capital market because the capital gains exemption is removed. That will push the Sensex down quite dramatically because people would like to take advantage of exemption. They whatever profit they're sitting on, they would like to encash because that's going to result in zero tax. That is one reason where Mr. Arun Jaitley, when he brought this provision, he also ensured, he said, whatever profit you make till 31st of January 2018, I will not tax it. So for that, he brought a concept called grandfathering of the provisions. Whether our grandchildren today know about grandfather or not, but at least introduce grandfathering and income tax. So a lot of times we are hearing in recent times grandfather. So when this section was introduced, if you see the finance bill at that point of time, none of the provisions were actually there. Everything was there in 112A. 112 is part of Chapter 12 of the Income Tax Act. Chapter 12 of the Income Tax Act provides for tax rates in certain special cases. Normally, tax rates are provided by the Finance Act. Chapter 12 of Income Tax Act provides tax rate in certain cases. So section 110 to 115 BBE, we have different provisions providing for tax rate in the Act itself. So there they were trying to define the cost of acquisition. See, you have to first compute the income taxable under 5 heads of income. Then you do a clubbing of income under Chapter 5. Then you set off any carry of loss at Chapter 6. That gives you gross total income. Then you get the Chapter 6 reduction. Then the total income. Then you calculate the tax either under the Finance Act or under Chapter 12 of the Income Tax Act. This is a scheme of law. So you cannot, in the provisions which deals with the calculation of tax rates, define the cost of acquisition, which was a mistake which was done at the time of introduction of bill. Of course, they subsequently corrected it when it became an act by introducing a new section 55(2)(a)(c), which provides for cost of acquisition of riches as acquired prior to 1st February 2018, because this is essentially for the grandfathering provisions. So what this section says, you take the actual consideration of fair market value as on 31st of January 2018, whichever is less, then you compare it with actual cost. So whichever is higher is going to be taken as the cost. So the cost of acquisition will be the least of the fair market value on 31st January 2018. The reason for the same being these provisions were introduced on 1/2/2018. The bill was introduced on 1st February 2018. So therefore, they want to have the cutoff of 31st of January. So compare that amount with the actual cost, take whichever is higher as the cost of acquisition. So that means even today, it is possible for you to get the loss on account of this section also. So only point is that what is the fair market value? Normally, you will find sections saying that average price and all the stuff in Rule 3.8. In many provisions we have seen, cost will be taken as the average cost. But I think the finance minister must be complimented by saying that he wanted to give the highest price on the stock exchange on 31st of January 2018. Take the highest price, not the average opening or closing. Take the highest price. And in case the shares were not traded on 31st of January, take the highest price on the immediately traded day preceding 31st of January 2018. So if it is not traded on 31st January, last trading was say 25th of January, take the price on 25th of January. So this is basically whatever profit which has accrued to you till 31st of January 2018 should not be taxed is the underlying logic behind introduction of 55(2)(a)(3) consequent to omission of 1038 of the Income Tax Act. So these are the provisions relating to shares and securities under the cost of acquisition. So we'll just go to the next segment in terms of to the extent of the provisions of set off and carry process applicable only to shares. We are not going to go into anything else, only relating to shares. So again, we already discussed about the capital gains have to be classified into short term as well as long term. So now till assessment year 2003-4, short-term capital loss, long-term capital loss distinction itself was not there at all. Any capital loss can be set off against any capital loss. There is no distinction between short-term or long-term. A lot of students used to ask me that question. Sir, long-term capital gains is taxed at 20%. A lot of short-term capital gains are taxed at 30%. So if I have a long-term capital loss, if you allow me to set off against short-term capital gains, the gain is taxable at 20%, but I'm allowed to set off with a loss which is taxable at 30%. So I used to tell them in the class, ரொம்ப சத்தமா சொல்லாதீங்க, இதுவா கேளுங்க, இது ரொம்ப சவுண்டா கேட்காதீங்க, சொல்ற பாயிண்ட் கரெக்ட், ஆனா அமைதியா கேளுங்க, ரொம்ப சாஃப்டா கேளுங்க அப்படின்ட்டு. But anyhow, the soundness gradually increased. The government also found, yes, there is a lacuna here. So therefore, a lot of students think short term is short term, long term is long term. The rhythm can nalla irukku, but that is not the law. I don't have a problem when you do the reverse, right? When you are having a loss, and if you're going to set off at a lower rate of tax, assume I have a short term cap loss. If I set off a short term cap, I can say 30%. If you want to do that 20%, I don't have a problem. The reverse is a problem for me. So that is why for the first time in assessment in 2004-5, it changed to short-term capital loss can be set off with both short-term or long-term. Long-term capital loss can be set off only with long-term capital gains. Of course, both can be carried forward for a period of 8 years. With short-term, it's available to set off with both short-term and long-term. Long-term will be adjustable only against long-term capital gains. So this is where the whole structure is going to come and how people used it effectively. We'll come back to that so that what they try to do in Finance Act of 2022 will shortly see. So the tax rates relating to shares, we are governed by 3 sections, 111A and 112A. So both we already had some discussion, but just we'll try to have a small discussion on that. So 111A basically provides for a short-term capital tax on short-term capital gains on listed shares or the units of equity-oriented fund, where the STT is paid at the time of transfer. When the STT is paid at the time of transfer, you pay 15% tax. Just to recall, when the section started, it was only 10%. Subsequently, they increased to 15%, but justifying by saying, since dividends are taxable at 15, capital gains should also be taxed at 15%. So that is something which they try to bring. Whereas 112A is a consequent introduction to omission of 1038. So where if you pay STT both at the time of acquisition as well as at the time of sale, so you have to, and if the capital gains happens to be a long-term capital gains, so in those circumstances, you have to pay 10% tax. So you pay 10% tax in excess of 1 lakh. So there is a exemption limit of 1 lakh is given. So we had a small issue at that point of time, whether if it is 1,10,000, should I have to pay 10% of only 10,000 or the entire amount? I think you have to pay only 10% in excess of 1 lakh. That means 10% of 10,000 is what you have to pay Rather than once you cross 10 lakhs, the entire amount is not taxable. So, but only requirement, you should have paid STT both at time of acquisition and transfer, subject to, of course, some exceptions provided. 112, if you don't fall under 111A or 112A, then you come under 112. For example, if I purchase a share, in one of the examples I've taken as 1,4,001. So where I would not be in a position to pay the security transaction tax at the time of acquisition. So there can be a question whether in those circumstances, can I perform what is impossible to perform without getting the third nitty-gritties. So if you're not coming under 111 or 112, because 112 specifically provides notwithstanding anything contained in 112. So therefore 112A is going to override 112. So basically 112 provides for 20% taxation after indexation. But however, in the case of listed securities, then 112 specifically says without considering indexation, your tax exceeds 10%. Without considering indexation, if your tax exceeds 10%, then the excess shall be ignored. So the language used in the section is excess shall be ignored. So that means it is mandatory. It's not optional. Suppose assume for a moment you missed out taking advantage of 10% without indexation. That means I have 20% after indexation or 10% without indexation. For some reason, we are not aware of this provision and you are paid tax on 20%, but 10% without indexation, if it is lesser, I think it has to be mandatorily considered because the section uses the word 10% without indexation shall be ignored. Even if the assessee, for some reason, fails to claim the benefit it's entitled to, you cannot deny him that benefit. That is what is very important. Just because I missed it out, you cannot go. See, just because I am assuming for a moment I missed out and paid lesser tax, they will not come back and give me. No, same thing is there. So therefore, if there is some benefit which I've missed it out, I think so you have to still allow the benefit. So that is something which is 112 proviso, which is very important. Even if you are not coming at 112A, still you are eligible for a 10% cap gains tax without indexation. So that you can still apply under 112 also. A couple of very important points are there is no chapter 6A deduction for all the three. Of course, if you're you can always take the chapter 6A for other income other than these three incomes. Rebate under 87A is surprisingly is not available only for 112A. So only for 112A you don't have 87A, but for the other two, 87A rebate is available. As far as the basic exemption limit is concerned, all the three are eligible for basic exemption limit. However, first you have to apply only for income which are taxable at normal rates, and if you still left out with, then what you will have. So in the practical cases, this could be of a limited use. But though there will be some challenge, if I have all the three and if I don't have any other income, where should I first apply the basic exemption limit becomes the question. It's not that I'm eligible for 2.5 lakhs for all the three. So I'm eligible only for 2.5 lakhs, just for the sake of simplicity. If you assume I don't have any other income, which is practically difficult, but just for a theoretical example. So in those circumstances, what should I do? So obviously, in the case of set-off, the courts have held that I should be allowed to set off the losses in a manner which is most beneficial to the assessee. So similarly, the same point can be applied here. I should be allowed to set off in a manner in which most beneficial. But the only challenge which might face is the utility, whether it's going to allow. See, in fact, I surprisingly found in the last year, against presumptive income, losses are not allowed to be set off by the utility. So if you go to section 44 AD or ADA or AE, they only say all deductions under 30 to 38 shall be deemed to have been allowed. So that means only unabsorbed depreciation the 32.2 cannot be set off against presumptive income. But if you have business loss or any other loss, then it should be allowed to be set off against business income under 44 AD also. But definitely, when I tried it, but definitely utility is not allowing it unless they've corrected now. But definitely it was not available. So though the law permits it, I think we still face a lot of challenges in the utility on this particular point. The benefit of indexation, as I said, is not available for 112 or 105. 112 is available, but still, if your tax payable is less than 10, exceeds 10% without indexation, that's going to be ignored. Set of losses, of course, allowed for all the three. It's not like winning from lotteries where it is prohibited. You can still set off the losses. So in this context, because of the original shares being original cost, bonus shares cost is 0. And there was an exemption for dividends available earlier under 1034, under the case of mutual fund, the 1035. So a lot of people were trying to create a loss which is not actually representing a loss, which required two very, very important sections to be introduced, which is 94.7 and 94.8. The 94.8 part of it is something which is very, very important because there is a very important amendment made by the Finance Act of 2022. So again, it is very important because of the fact that when we try to, whenever I had a discussion both in other branches on the similar point, so all of them are very consistent on one point. From Zerodha or any other brokerage, we download the tax workings or tax capital gains and then simply upload it. I definitely we have to be a lot more careful here because they are all technical platforms, fintech platforms. They may not have to be very, very thorough in the income tax, which is definitely not the requirement. As usual, they will also put a disclaimer. Okay, these are all what we are given. Of course, consult your chartered accountant or anybody before actually using this information for filing tax. I think that is something which I also definitely supplement that particular part. They are fintech companies, and definitely they do not have to be experts in income tax. But so basically, they just got a very limited application today, consequent to the third point. But unless we try to brief this particular point, it will be very difficult for you to understand section 94.8. And 94.8 we need to understand because when we file the next year tax returns, if there is any loss which has actually accrued, we have to be very careful because of the change in the law. So that's why I just thought I can touch upon this particular point also. Section 94.7 of the Income Tax Act, as just only for the benefit of all of you, it has lost its relevance on account of the third point. Any person buys or acquires any securities or units within a period of 3 months prior to the record date. So there are a lot of companies assuming that tomorrow they have fixed a date for dividends. So you buy it today, you will get the dividends because the record date is only tomorrow. If day after tomorrow, you will find the price will fall. Say, for example, some company declares a dividend of 100 rupees, setting tomorrow as the record date. That is the date on which the shareholders will be eligible for dividends. So let's assume it is 100 rupees dividends declared tomorrow. And the price of the shares is say 1000. So if I buy by paying 1000 rupees today, I'll get 100 rupees of dividend income because record is tomorrow. But day after tomorrow, it will go ex-dividend. The price will definitely become 900 because of this 100 rupees of dividend. So typically, since this 100 rupees dividend was earlier exempt from tax, I'll buy today for 1000, take the 100 rupees of dividend, and then sell day after tomorrow at 900 rupees per share. So I will have a loss of 1000 minus 900 to 100, but there is no real loss because that 100 in any case has come to me by way of dividends, which is also exempt from tax. So this 100, depending upon whether it is a business income or capital gains, either there will be a business loss or short-term capital gains loss. If it is a business loss, I can set off against any head of income except salaries. If it is a short-term capital loss, I can adjust against short-term or long-term capital gains. So that is one reason why they introduced 94.7 so that people don't misuse this section. You should have acquired the shares 3 months prior to the record date. So if the record date is tomorrow, so you should have purchased 3 months before. It's very difficult for it to anticipate dividends 3 months before. That is the underlying logic. So point is that what should be the date? 1 month or 1 week or those things. If you fix the date as 1 week, people buy 8 days before. If you buy 10 days, they will buy 11 days before. So 1 month means they will buy 1 month before. They have to put that, but they've analyzed the declaration of dividend never happens 3 months prior. Therefore, they put the cutoff as 3 months. Now, you should not sell within a period of 3 months in the case of securities like shares, and in the case of units, 9 months after such date. The last and the most important point, the dividend or the income from mutual funds should be exempt from tax. Consequent to omission of 1034 and 1035, so we can safely assume that 94.7 has got no relevance today because once income is not exempt from tax, Absolutely doesn't make any sense, because if you are in a 30% tax bracket, you cannot definitely set off at 15-20% and pay 30% tax. It doesn't make any sense. First, if you also take the people coming under the highest slab rate, they should be placing close to 43% tax. It makes no sense for them to pay a dividend at 43% tax and book a loss and set off with a lower rate of tax. No, that doesn't make any sense. Of course, in any case, section does not apply. But this is what we popularly call as a dividend stripping. But the concept of bonus stripping, so a similar point was applicable for bonus also, because once the dividend stripping section was introduced, so a lot of companies and mutual funds started giving bonus instead of dividends, because if you give bonus, it is not exempt from tax. Bonus shares today is not exempt from tax. It does not come under 222A or 222B of the income tax act. So the question of exemption never arrives, even at the time when the shares dividends were exempt from tax. So the bonus is always a capital receipt, not taxable, but not exempt from tax under 10. So therefore, 94(8) was introduced to prevent the bonus stripping. So any person buys or acquires any units or securities within a period of 3 months prior to the record date, such person is allotted additional units or securities without payment on the basis of holding of such units on the date. So I've highlighted securities in yellow shade because that was introduced only from 1st April 2022. So that means till 31st March 2022, the provisions of 94(8) does not apply. The provisions of 94(8) does not apply to bonus shares. It is applicable only for bonus units. It was never made applicable for bonus shares. But from 1st April 2022, they extended the scope of this particular provision to shares also. So till 31st March 2022, loss on account of bonus shares not covered, though of course there is an exposure to general anti-awarded provisions, are very popularly called as GAR provisions under Chapter 10 of the Income Tax Act. That is always that exposure is there. When you cross a threshold limit of 3 crores, that could always be invoked, but not under the provisions of Income Tax Act. So such person is allotted additional units or securities without payment. Take it as bonus. So I buy the original shares. So I get the bonus shares. Or such person sells all or of any of the units or securities referred in clause A. So I take it and read it as original. I sell the original, but retain the bonus. Now connected this with, if you are wondering why I should talk about in length about 55(2)AA, connected with 94(8). Original shares, original cost. If all of them are average cost, the need for 94(8) does not arise at all. Since my original is going to be original cost and bonus will have a 0 cost. So we will take a very simple example of a 1:1 bonus. What would happen on account of a 1:1 bonus? I'll just give you a very simple example. I'll assume a simple. So 30th June 2022, a company issues bonus shares in the ratio of 1:1. So you buy on 29th June 2022, say 10,000 shares at 100 rupees per share. So you will subsequently get, because of record date with 30th June 2022, you will get another 10,000 shares at 0 cost. Now, what will happen on 1/7/2022? Without consulting the market on that particular day, assuming that there is no significant change on account of other factors, the price of this share should fall to 50 rupees per share, because it's a 1:1 bonus. So the shares are at 100 on 29th of June. So it will become 50 on 1st of July. So what many people are trying to do, so since original shares will have original cost, so I will have a 50 rupees of loss. So multiply by 10,000 shares. So I will have a loss of 5 lakhs. Now, have I actually having a loss of 5 lakhs? The answer is no, because I have 10,000 bonus shares and the share price is 50. So therefore, I'm going to have 5 lakhs. So therefore, there is no real loss, but I can have a business loss of capital gains loss of 5 lakhs by subscribing to the bonus shares. And thereby you can set off against either if it is a business loss against any rate of income except salaries, and thereby saving even up to 42%. So if you want to treat this as a capital loss, you can set off against capital gain short term or long term, thereby saving 15% or 20% tax. It's very surprising. You just recall our discussion. Assessment year 2003-4, they brought the change. All capital loss against all capital gains. They introduced from 4-5, short term with both short term and long term. Long term with long term. Why this? Reason I already told you. Since long term is taxed at 20%, I should not be allowed to set up the loss arising out of that to higher rates. The very next year, when they brought this 111A, they have not specified that a capital gains which is taxed at 15%, the loss on that should be taxed at only at 15%. Till date, it is not there. Till assessment at 23-24, this provision is not there. So that means you can set off the loss arising on account of listed shares, which is taxable at the rate of 15% against any short-term capital gains, even if it is taxed at 30% plus, or even against a long-term capital gains is taxed at 20% plus. But is still there. As a matter of fact, I don't know how many of you have thought about this. Long-term capital gains tax was introduced from assessment year 93-94 up to 92-93. But the long-term capital gains, if you have 10 lakhs, you will get a standard action like what you are having in house property or in family pension or in the case of interest enhanced compensation. There's a flash standard action was brought in for long-term capital gains for inflation. But only from 93-94, the concept of indexation was introduced. The concept of indexing the cost of acquisition, cost of improvement was introduced from assessment year 93-94. But there was a lot of stiff opposition to that particular change because a lot of people thought it was pretty confusing. So the finance minister at the point of time said, okay, we will tax you at the concessional rate. Why 20%? Go to 93-94, you will find the first slab rate at that point of time is 20%. The first slab rate was at 20%. That is what sometimes I used to wonder. The lawmaking in India is very, very unfortunate. When this is the principle under which you have introduced, when the tax rate is reduced, you should have automatically reduced the tax rates for capital gains because the purpose of 20% at that point was the first slab rate. So you cannot even forget why the section was introduced and then have a different law. Even today, long-term capital gains tax continues to 20%. When your first slab rate gets reduced, there is a necessity to reduce because that is the intent of the law. So otherwise, you enhance the basic exemption, keep the first slab rate, continue at 20%. So I think this is how sometimes I think the lawmaking in our country has to improve because when you are adopting the same legislation, you should know why that particular legislation is introduced at that point of time. I don't think the parliament which has approved at that point of time has to be seized of this matter and you should continue with that. If you don't do it, I think we are doing an unfair legislation. Purpose, if you lost it, I think it's not right. But unfortunately, all of us have a limited memory on everything. So be it in terms of the gratitude or anything as a matter of fact. So we Indians are a limited memory. We also not really bothered about why this particular lawmaking. That's where we continue to have quite a lot of issues in lawmaking. So the complexity is more attributable to this, but be it is. So now in this particular case, this was the benefit with some people, especially some high net worth individuals are considered. So what they have done till 31st of March 2022, there is no problem because the section was not covering shares. It was only covering units. So I can set off this clause. Therefore, so what they have done now. So if you go to 94.8, they've added after the word units, securities also from 1st April 2022. So what is the implications of this? So the implications of this are, if you purchase the shares 3 months prior to the record date. Take for example, REC, which has got a bonus shares on 18th August 2022. The Rural Electrification Corporation, which is one of the Mahanavaratna of the Indian government, has got a bonus issue. 1:3. 18th August 2022 is the record date. If you buy the shares today, will you get the bonus? The answer is yes. Assuming you buy 3,000 shares, you will get on 18th August 1,000 shares. But however, since it is 18th August, 3 months prior to the record date, if you have acquired prior to 15th of May, the shares of REC, 18th of May, there is no problem at all because section will not apply. That means you can exit the shares on 19th August itself because there is going to be a fall in the price. You can still do it, not a problem. What if you purchase only today after listening to this? Okay, fine, you decide to buy. What should you do? Is a question. One, if you buy the shares today, you have satisfied the first condition 3 months prior to the record date. So you got the original shares. Let's assume you buy 30,000 shares. You're going to get 10,000 shares on 18th of August. Or such person is allotted additional units, you will be getting on 18th of August. And such person retains the original, rather retains the bonus, but sells only the original. So that means if you're going to get the originals, you are not supposed to sell up to a period of 9 months. As such person or additional units with their payment, such person sells or transfers any of the security units effort in class A within a period of 9 months after such date, which is the record date. So I cannot sell for 9 months from 18th of August as shares. What if you do? Whatever loss which you are incurring on these shares will have to be ignored. Whatever the loss on the original shares will be ignored. That instead will be added as the cost of acquisition of the bonus. So the loss which is ignored will become cost of the bonus shares. So we have one very peculiar problem while filing the tax returns for the next year, because we have to really find out whether these scripts are subject to a bonus issue, and we have to apply this. Whatever loss which you get on account of original shares, we may have to ignore, and instead of zero cost, we have to add this as a cost of acquisition of the bonus shares. But again, is the bonus stripping? Therefore, can we say, is the bonus stripping, has it been closed? I will just point out only 2 shares which came out with the bonus in the month of June. There are something in April. So one of them is Ajanta Pharma. So it was, if my memory is right, it's on 22nd of June. So you buy on 21st of June, and then you sell. The 9 months is going to expire in this same financial year, right? So by 23rd of March, if you're going to sell, you will not be satisfying the second condition. Please understand, the conditions are cumulative. It's not alternative. It's not that if you satisfy one condition, section will apply. If you purchased on 22nd of June, and in case by 23rd of March, there are 2 possibilities that the Ajanta Pharma shares price have gone up dramatically. In that particular case, you may not incur a loss, but still doesn't matter. You have generated profit to pay the tax. If it continues to incur a loss, again, there is no problem because you can set off that loss against your capital gains. So therefore, still the possibility exists, but one thing is that in the first 3 months bonus issue, you have to identify and then sell it. So in those circumstances, the benefit could be still available. The only point with futures and options, the only question you might be having, or on behalf of your client, okay, fine, the share markets are subject to fluctuations. I've seen a lot of mutual fund advertisements mutual fund investments are subject to market fluctuations, and therefore please read offer document, all those things. We give a disclaimer report, mutual fund gives a disclaimer report, all of us give a disclaimer. That's fair enough. But with the emergence of futures and options, which is basically introduced as a concept of the hedging tool. F&O was never meant for speculation or making profit. When it was introduced, it was introduced only as a hedge against the risk. So therefore, if the stock falls under the futures and options, you can always take a put option, which is available up to 3 minutes per hour, depending upon some script may not even quote for a longer period of time. But so definitely month on month hedging is still available. So you need to make a small premium to protect against a downward risk. And thereby, so what you can do is you can still structure it. If you make a profit, no problem, use the profit to pay the tax. And if you make a loss also, you can protect yourself by using some put options under the F&O category. So therefore, this is something which we need to explore. There are some other possibilities are there. Considering the limited time available, I will skip that. But however, so that's why I just given. The implications are loss on original units will be ignored. The loss ignored will become the cost of the bonus shares. Most importantly, the 94.8 are applicable only for units up to assessment at 22-23, and it's applicable for both units and securities from assessment at 23-24. Therefore, for this year return, you don't have to find out whether a loss has arisen on account of a bonus issue. No problems at all. If it has arisen on account of bonus issue, you are entitled to take the benefit out of it. Not a problem at all, but not from next assessment year, where you have to be slightly careful while filling up the tax returns. So just a very quick comparison between 94.7 and 94.8, which is 7 is for dividend stripping on account of exemption from dividends has been ignored. This section has lost its relevance. 94.8 is for bonus stripping. So 94.7 is both for shares and units. 94.8 only for units up to 31st March 2022. Both for units and securities from assessment at 23-24. Relevance lost consequent to removal of exemption of dividends. Scope widened from assessment at 23-24, but still 94.8 is alive, especially first 3 months bonus issue. If you are able to identify, then you can still 94.8 is an option available. So a couple of examples for you to just visualize whether it is some benefit is available for this. So HCL Technology, it announced on 23rd of October. The bonus was on 5th of December. 1:1 is the bonus issue. I've just given the price on the various dates. So on the date on which they announced the bonus, just will take only the last coin, 1,102 is the price. I'm just taking, don't consider too many columns. It was taken from NAC website for the set. So 1,100 was the price on 23rd of October. 5th December after the bonus issue was 560. You can find it close to half it has come down. So 28th June, the price was 1,001. So you can just see in about less than 3 years time, it's almost doubled. After the technology stocks are getting a smashing for the last 6 months or so. Still, yesterday itself price was 900, which is much bigger than this 561. So therefore, still, apart from saving tax, on a downward market, especially for information technology, and still you find there was a huge return even after this, after factoring the downward conditions, especially overall downward market, more particularly information technology. You had still, I think the HCL Technologies and F&O stock, there's always a protection is available. So again, TCS is a classic example. So you can just from 800 to 3,318. Of course, there are some corrections, but still, it's still worthwhile. Infosys had a lot of bonus issue 2014, 2015, 2018, and still you can find from 2014, 3,000 after 3 bonus issue, the ratio of 1:1. Still, there is a huge return to be made. So apart from there is a tax saving opportunities available, there is a huge return. Of course, all the stocks are F&O stocks, there is a protection also available by taking a put option. So this is something which we need to really consider. Apart from it, there are, as I told you, there are some other this thing is there due to time constraints. Just maybe I can take it off and at a later point of time if you have any clarifications or questions on these points. So those are all related to that. In fact, so there was a question here on, I mean, while my profile was read out, it's called as a capital gains Suresh or TGS CGS, and this was actually, I want to credit this to our past president, Mr. T.N. Manogaran, who in one of the programs, in my second program, when he was there in the program, he was the one who just kept this name. So I just give a small background. We just read this 54 about the capital gains account scheme, which all of us will be aware of. So here, the amount of, if you read this particular section, the amount of capital gains which is not appropriated by the SSC towards a purchase of new asset made within 1 year before the date on which the transfer of the original asset took place, or which is not utilized for the purchase or construction before the date of furnishing of written off income under section 139(1) or under section 139. So just read this part of it under the fourth line. So basically all of us will be aware of, I have 2 years to purchase, 3 years to construct under section 54 and 54A. So by the time of filing of tax returns, if I'm not able to purchase or construct, what should I do? So when I was on articles, so what we used to do is, we will claim the exemption, give a small note, being a Adi Masam, not easier relate panna. Adi Masla pathina 50% off. Kira pathina slow or font size 3 conditions apply or on select models. The 54 exemption 54F alarm போட்டு ஒரு கீழே ஸ்மாலா ஒரு font size கம்மியான font size ல கீழே ஒரு நோட்டை போட்டுரும். The SSC has got 2 years time to purchase or construct. This is a fact. So he will purchase and send the proof as and when it is required. ப்ராப்ளம் என்னன்னா, இந்த மாதிரி salary class இருக்கிறவங்க capital gains நமக்கு அந்த வருஷம் மட்டும் தான் நம்ம கிட்ட ரிட்டர்ன் ஃபைல் பண்றதுக்கு வரும். Capital gains முடிஞ்சதுக்கு அப்புறம் he will not come, because for him only if there is a salary return, he himself will file, or he can go to some HDFC bank or any bank. They themselves will file virtually either for free of cost or for a very, very nominal amount. There is necessity for him to come to chartered accountant does not arise if he doesn't have a capital gains for the salary class. பட் இதுல என்ன ப்ராப்ளம்னா, நம்ம விட்டு போனதுக்கு அப்புறம் நம்ம கிட்ட இருந்தா நம்ம சொல்லிருப்போம், இந்த டெபாசிட் இந்த இது நம்ம வீடு வாங்கினே நீ கிளைம் பண்ணும் அப்படின்றத, நீ வீடு வாங்கணும்ன்றத நம்ம சொல்லுவோம். பட் நம்ம கிட்ட இல்லாம இருக்கிறதுனால நம்ம அவனுக்கு அது தெரியுதே இல்லை, நம்ம எக்ஸம்ஷன் கிளைம் பண்ணிட்டு அதோட நினைச்சிடுறோம் ஆக்சுவலா. So that is why the government brought a scheme called Capital Gains Account Scheme of 1988. So where they said, if you are not able to purchase before the due date for filing tax returns, you should deposit in the capital gains account scheme, which you have to open in a public sector bank, not being a rural branch. Bank la poi capital gains account scheme la poi deposit pannu. Angirndi you have to purchase or construct, because the bank will directly give the amount to the builder. So therefore the government is protected of the revenue, and SSC also சும்மானா ஜஸ்ட் நான் வீடு வாங்குறேன்னு சொல்லிட்டு எக்ஸம்ஷன் எடுத்து ஓபி அடிக்க கூடாது, ஓபி அடிக்க முடியாது. அதுக்காக தான் that was specially brought in. But if you look at the fifth line, it says before the date of furnishing of written off income under section 139. So here you don't find any subsection there. We all know 139 will have 139, 1 or 4 or 5. But whereas shall be deposited by him before furnishing such return, such deposit be made in any case not later than the due date applicable to the case associated for furnishing written off income under 139(1). So you find a very interesting point here on the fifth line, it is 139, whereas on the eighth line, it was 139(1). This was my second program where I was speaking in the CS study circle. So where I was telling the very senior members who are present there, that if you could not purchase or construct before the filing tax returns, and if you also don't want to deposit, hold the return. இன்னைக்கு நமக்கு belated return time குறைஞ்சு போச்சு. முன்னாடிலாம் all of you will be aware of it. Had this 2 years from the end of the 11th assessment year. Effectively 3 வருஷம் கிடைக்கும் belated return file பண்றதுக்கு, which is a time available for investment in residential house. So the return hold பண்ணும். You buy the residential house, then file the tax returns. You don't have to deposit because it only says before the date of furnishing revenue of the 139 subsection was missing. Only when you want to deposit, you should deposit by capital gains account scheme, and that should be done by 139(1). So deposit panna poradilla, you can purchase even without depositing. But a lot of senior members who were present at that meeting, they specified, Suresh Nichina Paina Rikara, he solved the point correctly. Ana one one. So 139 in the 5th line and 138th line, they should be read together. So therefore, in the 139, the 8th line, that should also be 139(1). But anyhow, you are a youngster, we just want to bring your point of it. Mr. Manogaran was the past president, was sitting in the last this thing, observing all these things. He said, I heard all of you, I heard him also. I concur with him because his interpretation looks very, very logical and very correct. Whether it is right or wrong, there is a lacuna in the law. So therefore, I concur with him. I think we have to appreciate his interpretation. I think it can withstand the law. That is my view. And for this discussion itself, we have to, I have to tell him that from today, I think it should be called as CGS, not TGS. This was actually full credit has to be attributed to the past president of ICI, who was gracious enough to come back and encourage an youngster like me and come back and say these big words. This is the second meeting or so. Because under should be around 25 or 26 at that point of time, or doing at that point of time to have this. So nevertheless, that's a very interesting nostalgia for me. But what has actually happened today, it's very interesting. The courts have held even capital gains deposit scheme can be made, capital gains deposit scheme can be made under 139(4) due date. They have taken a different, Punjab and Nanakat have taken. And recently, Madras High Court has taken a stand, since all of you are the state of Tamil Nadu, that you can purchase a consent without depositing also. Without depositing also. A lot of decisions are also in favor. Other capital gains deposits scheme, you can purchase this also. That's not fatal to the claim, except of course there is a Bombay Court judgment. So therefore, the law is evolved differently, interpretation was done differently. The courts have said 139(1) will also be 139(4) because 139(4) is a dependent section. It's not an independent section by itself. It is dependent on 139. Tomorrow, if the government comes back and says there is no need to file the tax returns, and they remove 139(1), I don't know, 139(4) automatically dead. You don't have to kill 139(4). Killing of 139(1) automatically will kill 139(4) because 139(4) is not an independent section. Today, there is a requirement to voluntarily file a tax returns at a 139(1). 139(4) only gives you more time to do that. That's all. If I kill 139(1) and I can kill 139(4) without killing, without enacting or removing 139(4), because it is automatically removal of 139(1) kills 139(4). That's such sections we call it as a dependent section. So 139(4) is not an independent section, cannot exist on its own. Its existence is subject to 139(4). So therefore, some courts have said 139(1), 139(4), we can interchange, and therefore even you can deposit capital gains accounts can be for 139(4). And of course, Madras High Court, Karnataka High Court, even an extreme stand, you don't even have to deposit. So those things, interesting dimension, because they've read out this particular point. I thought I can recall this. This, of course, can also be used along with some other point. That's why I kept it. As I said, already we are 12:54. Therefore, I just want to skip this discussion further. So still there is an upcoming bonus issue, which I've taken only one, which is a worthwhile. I mean, a company which is of repute, which has given a bonus issue, which is a large scale and which calls on F&O 1:3 on 18th of August, which still we can consider. So as far as F&O, the frequent questions on the futures and options side of it is one, how to consider the turnover part of it. Assume there is two things. One is the future, and other one is the option. So in the case of a future, It's very simple. The turnover, see, I've taken few examples based on the recent, except for the fact the sell price of ICICI Bank is definitely not 730. In fact, before I start the today's session, I've already found it is well beyond that 750. But since we should take one profit and one loss, I've taken this. So if somebody purchased Adani Ports, which has a lot size of 1200, purchased for 700 and sold for 750. So you would have made a net profit or loss of 60,000, which is also going to be considered as a turnover. Though ICICI Bank, the today's price is not actually 730. So I just taken for the sake of example to have a loss. Its lot size is 1250. So there is going to be a loss of 25,000. So we'll remove that negative, take the turnover as 25,000. Therefore, the total turnover for this futures is going to be 60 plus 25, 85,000. Whereas my profit or loss is going to be 35,000. So now the question which comes is how much profit I should make. Can I show 6%? But the question of 8% of 4480 does not arise here because of the fact all transactions are going to be only in, it's not going to be in cash. So 85,000 into 6%, can I show? My answer is no, because you have made a profit of 35,000. So therefore, unless you are able to establish that there is a brokerage and other expenses are going to be incurred to the extent of covering the 6%, it is not possible, because that is why the section allows you the flexibility of offering more than 6% also. So here 35,000 is your profit. So 6% of 85,000 is going to be much lesser than that. You should still offer 35,000. Maybe you can consider certain expenses which you have incurred. Or I will put it this way: if you show 6%, it is not possible for you to show this source for of any of your asset beyond 6% of 85,000. That is the point. So once you show 6% of 85,000, then it is not possible for you to show I have a source for my investment tomorrow to the tune of 60 minus 25, which is not possible. So that is one precautionary check. Either you offer 35,000 or go for 6%, means source is not there for your future investments. So futures are a lot more simple. The net profit or loss is what is going to be considered as a turnover. But when it comes to question of option, it's going to be slightly different. So again, these are all some examples. Again, the only thing is that the example I've taken, the premium of 76, which was there in the last week on certain strike price. But today the selling price, what I've taken is different from what is actually the position today. So these numbers, the premium is part of it is actually the live data, but the sale data may not be live, but it's an example alone. So Asian Paints for a lot size of 200, I paid a premium of 76 and I sold it for 80. The loss or profit is 4. So now the question is, what is going to be my turnover? So there it is going to be the 16,000 plus 800. The turnover will be taken as 16,800. That is the sale plus the profit or loss, ignoring the signs, is going to be our turnover in terms equation of option. So similarly, if you take the case of a Berger Paints, so there is a purchase of 13,200. There is a sales of 6,600. These are all the premium at which you are difference between. Say you have a spot price, you have a future price, and you want to buy at a future price, paying a small premium. So that is what we need to understand here. So my turnover will be taken as 200 into 80 plus the profit or loss, removing the integers. So there's going to be 16,800 plus 13,200. So here the total turnover comes to 30,000, and whereas I have a loss of 5,800. So now I have two options. I go for 6%, or if I want to claim the loss. In those circumstances, the only question which arises, will the provisions of 4480 apply? See, here there is a problem with the utility, which is sometimes not stating the law. Now 4480 as such was a very interesting section when it was introduced in 1994. It had for civil construction and a 4480. First 4480 remains the same forever, and you have 44AF for retail trade. So you had 3 presumptive income, popular presumptive income schemes at that point of time. In assessment year 11-12 onwards, they merged the scheme for all businesses. Therefore, 44 AFS to be left out. You had AD and AE. And from 17-18, you also had the professionals getting the opportunity under 44 ADA. So where there is a presumptive income of 50% or more. So 44 AD evolved over a period of time, 8% or 6%. But when the section was introduced, if you don't offer presumptive income, they said you have to be compulsorily selected for scrutiny. So that was the original provision. Subsequently, they said that if you don't offer presumptive income, you should get yourself audited. Surprisingly, they said you should get audited, but they never said you have to maintain books of accounts. So how can I do an audit if the books of accounts are not there? That lacuna they corrected. They said you should maintain books of accounts and get yourself audited, provided you show lower than presumptive income. But subsequently, they made another change. They said that from assessment 11-12, you should offer income below taxable limit and the total income should exceed basic exemption limit. So two conditions for audit. Income should be less than the presumptive income, and then your total income should exceed basic exemption limit. By the time we are just trying to understand this particular point, 44 AD from assessment is 17-18 went through another change. The tax audit under clause C of 44 AB is required only if subsection 4 of 44 AD gets attracted. So subsection 4 of 44 AD should be attracted for tax audit under 44 AB clause E, because AD comes are there. What is AD4 saying? Point number 1. You should have offered income for any of the years under 44 AD1. That means you should have either shown 8% or 6% in any of the years. Then within the next 5 years, assuming that in 2021, I offered 8% or 6%, then 21, 22, 20, 23, 23, 24, 24, 25, 25, 26, in any of these 5 years, I'm not opting for 44 AD. If you do that, you are automatically going to be chucked out of 44 AD for the next 5 years. So very, very complex. I don't know. These are supposed to be a very simple provisions, enacted most complicated. And what is more important, the provisions for audit are different for ADA, different for AE. The case of AE, even today they continue. If you show lower than presumptive income, audit is must. But whereas in ADA4, same as erstwhile AD, you're offering less than 50%, your total income should be above basic exemption limit. In AD4, unnecessary confusion that one, you should have already offered under 4481. Then within the next 5 years, you are not going for 4480 or you're offering lower than 4480. And if you do that, the next 5 years, you are automatically can never choose 4480. And if 4484 becomes applicable, and if your total income exceeds basic exemption limit, then you should get yourself audited. The problem is, assuming for a moment, I never chosen for my F&O 4480. Will 4484 apply? The answer is no, because I've never opted. See, the requirement of 4484, you should have opted for 44 any of the years. If you are never opted for 4480, the question of 84 may applicable itself does not arise at all. So therefore, right from first year, if you have never gone for 4481 application, the question of applying 4484 does not arise, and once 4484 is not applicable, AB on account of clause E will not apply, but it may apply on account of 44 AB clause A, not on account of clause E. If you come under clause A on account of business, then the question is what we have to consider in that particular case, whether you are coming under the proviso, which is 95% of rescission payment should be otherwise than cash, that is 10 crores. Otherwise, the limit is 1 crore. So this is a very, such a very simple scheme, complicated to the maximum extent. So this is comprehensive here. I think there are some other small issues are there, like business and capital gains, and it's a very complex. I mean, I don't think after going through we'll get any clarity. So those are meant for clarity, but once you read, you will be more confused than ever. I'll take just 2 points here. Can a doctor choose 4480 for F&O and share business? That's a very interesting point, because in the case of 44 ADE will be opted in the, if the doctor opts for say 44 ADA, then he's actually prohibited from coming at a 44 AD on account of 44 85, because if you are a profession referred to in 44 AA, 44 AD is not applicable for that person itself. So therefore, the question of doctor choosing does not arise because of 44 85. If you are a specified professional, the question of choosing 44 AD does not arise because of a specific prohibition. The 44 AD is interesting word. There is a concept called eligible business, eligible person. Eligible business means, they have said, any business other than 44 AE. Eligible person means any person other than person having commission business or agency business, or person having specified profession referred in 44 AE. Since a doctor, a medical profession is a 44 AA profession, so the question of he choosing 44 AD for F&O does not arise on account of this, because he is not an eligible person. But the turnover from F&O to be included for professionals for tax audit purposes, in terms of the calculation of either for 50 lakhs or 10 crores or 1 crore, not to be considered. You can't club both the receipts, because one comes under class A, other one comes under class B. You can add the turnover of multiple businesses, multiple professions, provided it comes under class income. So there is no provision to add the gross receipts of class A with gross receipts of class B. You can't put, because they come under different classes. F&O comes under class A, whereas the gross receipt, the profession comes under class B. Therefore, you cannot add both A and B for arriving at the number. So therefore, you have to individually consider whether the F&O turnover for class A and gross receipt for class B separately. When you can't mix the two for the purpose of considering. So with that, I'll just keep the floor open for whatever time Madam says, because already we are at 1:10 closely. So that's already taken 10 minutes more than what I should have taken. Madam, I'll leave the floor to you. Either you want to take the question right away, or we can also take the question offhand also. Maybe I can just, whatever questions we have, I can compile. That's what we did in Umona, because it took almost 3 hours. We started at 10:30.
Can come out with any of your queries you have. Either unmute yourself or you can put it in the chat box.
Before the question comes, I take this opportunity to thank the Madurai branch for giving me the opportunity. Of course, as always, I really enjoyed the 2 hours. Actually.
Sir, good morning, sir. I'm Ravichandran.
Good morning.
So a doctor who is running a profession,
Sir, Ravi sir,
also running a medical shop.
Ravi sir, come out in one device.
Hello.
Yeah, thank you, sir. So a doctor who is running also a medical shop, whether a medical profession can be under 44 ADA and a medical shop is under 44 AD.
No, sir. In 4485, everybody talks about overall eligible person. See, 3 concept நம்ம ஏரியில இருக்கு. Eligible business, eligible assessee, eligible person. Eligible businessல என்ன பண்ணிட்டாங்கன்னா, any business other than 44A ன்னு கொடுத்துறாங்க. That means all business eligible, provided eligible assessee you must be an individual, HUF or partnership firm other than LLP resident in India. So first நம்ம அதுல வரதான்னு பார்த்தப்போ individual HUF firm. அது வந்துட்டு நம்ம அஸ்யூம் பண்ணிப்போம் ஆக்சுவலா. So eligible businessல the answer is yes, because it is an eligible medical shop is an eligible business as such. But 85 என்ன சொல்றாங்கன்னா, I think seems to be a very conscious attempt மாதிரி தெரியுது ஆக்சுவலா. Who are all not eligible for 44 AD. So adula enna solrukana, if you are having a commission or agency business, you are not eligible for 44 AD at all. Similarly, if you are having a profession which is specified in 44 AA, medical profession is specified 11 professions இருக்கு 44A including notified professions. அதுல medical இருக்கு. Now since the medical profession is already notified, the doctor becomes an ineligible person under 44AD. But இது ஒரு சிம்பிளா இதை ஒரு சால்வ் பண்ணலாம் சொல்லலாம். பட் அவரோட HFO அவரோட வைஃப் பேர்ல அந்த ஷாப் நடத்தலாம்.
Oh, thank you, sir. Sir, another query. A person not offer for taxation under 44AD earlier. This year, he is showing income less than 6 or 8%, but it is more than the minimum amount not taxable tax.
The 84 நான் ஏற்கனவே டிஸ்கஸ் பண்ணேன். இப்போ இதில் ஸ்பெசிஃபிக்காக சொல்லணும். Strictly speaking, forget about whether utility allows or not, will not get into it. But I'm only talking about the law here, not the form. Law body audit will not apply because 4484 presupposes that you have already offered income under 4481 in any of the years. In 4481, if you have never opted or if this is the first year, then the question of 44AB does not arise. Neither class E supports that nor 4484 supports that. So,
Thank you.
So whether loss or profit, whatever it is, we can just like that show as a business without tax audit.
பண்ணலாம் மேடம். Subject to other conditions of tax audit, also we assume it is not satisfied that turnover of 1 crore or 10 crore as the case may be. So you should not come under class A la varakudadu avladha. Class E applicable கிடையாது. But 44AB has got 5 classes here. So only the class E la varadu, but we have to still test class A. But class A la vanda unga number of audits la kuda count agum. Adukka solra. Class E la vanda audits number la kanaka avadhu. Class D liyo E liyo vanda audit number ku count agu porthilla. But class A la vanda number of audits la correct agum actually. So another we have to still test 1 crore 10 crore concept. It still be hard to check.
Any other queries?
Good afternoon, sir. This is Uma.
Good afternoon, madam.
In the case of mutual funds, this concept of IDCW, that is income distribution come capital withdrawal, this has been introduced now. And the amount of IDCW is credited to the bank account. And when we look at the profit and loss statement given by the mutual funds, the whole amount is shown as redemption. So how do you treat that? Is there an element of income distribution in that redemption amount?
ரொம்ப ஒரு
Because
காம்ப்ளெக்ஸ்
the dividend is part of that IDCWங்கறாங்க.
ஆமா அது நிறைய அந்த இதெல்லாம் இருக்கு மேடம். ஆக்சுவலா நம்ம இதை ஆஃப் ஹேண்டா அதை நம்ம இதை எடுத்துப்போம். ஆக்சுவலா இட்ஸ் வெரி டிஃபிகல்ட் டு எக்ஸ்பிளைன் ஓவர் திஸ் திங் இன் 2-3 minutes ஆஃப் டைம். ஏன்னா அது என்ன இது இருக்கு, நிறைய அதுல இது இருக்கு ஆக்சுவலா. ஸோ இது என்ன மாதிரி ஃபண்ட், என்ன டிஸ்ட்ரிபியூஷன் அதெல்லாம் இருக்கு. ஏன்னா இட்ஸ் அ வெரி காம்ப்ளெக்ஸ் ஒன். இதுல நிறைய ஸ்கீம்ஸ் இருக்கு ஆக்சுவலா. ஸோ ஐ திங்க் திஸ் இஸ் சம்திங் விச் வி கேன் டேக் ஆஃப்டர் திஸ் ஆல்சோ. ஆஃப் ஹேண்ட்ல நம்ம எடுத்துக்கலாம் ஆக்சுவலா. வெரி டிஃபிகல்ட் டு எக்ஸ்பிளைன் இன் தி online mode without understanding full details of what the scheme is all about.
Suresh sir, in the example of that options turnover you are given, I saw that you had included the sale of options and the profit actually. But the guidance note on tax audit says that you have to add only the, I mean, it says premium received on sale of options is also to be included in turnover. Now by adding that profit, aren't we adding it again?
இல்ல premium is also should be included in சொல்றோம்.
Also profit plus premium மீன் பண்ண கூடாதுங்க சார்.
ஆமா இல்ல premium should also be includedன்றனால தான் அப்படி எடுக்கறோம்னு சொல்றோம்.
இல்ல அந்த premiumல see today when I bought for say 10,000 rupees worth of options and I'm selling it for 16,000 rupees where I'm making 6,000 of profits, my 16,000 is the sale which includes 6,000. Yeah, yes sir.
So இதான் அந்த how the also to be includedன்றது இதே மாதிரி 147 இந்த மாதிரி ஒரு interpretation has been done. So அந்த also to be included இருக்கிறதுனால so apart from the net figure ignoring the integer we are also considering this.
But is it not duplicating it, like my sale which I do includes profit and I'm adding one more profit again?
அதுதான் இதுக்கு என்னன்னா நம்ம ஃபர்ஸ்ட் பாயிண்ட் டிசி நம்ம என்ன பண்ணோம்னா how the concept of option works, what is the strike price, what is the spot price, what is the different price, I think that should be our first session on this, and therefore it is easier for me to explain why I am trying to include there, because இப்போ இந்த இதில் பொறுத்த வரைக்கும் அது நமக்கு மெயினான ஒரு அண்டர்ஸ்டாண்டிங் தேவை இருக்கு. So futures becomes little more simpler because it works more like a spot price. But whereas options or idella portha varaikkum you have multiple strike price and cash at the call. I think it's a very, very interesting. So adana vandu if I take some time to explain how various strike works, what is option, how it decays appdi நம்ம சொல்லிட்டு இத நான் கொண்டு வரும்போது இன்னும் கொஞ்சம் இதுவா இருக்கும்னு நினைக்கிறேன் actually. But as of now, if I try to explain, I don't think it is possible to understand, because first we should know how the option as a fundamental works. அது நம்ம பண்ணிட்டு போகும்போது possibly there is a possibility for me to catch up with all of you as to why I'm taking that. அது இல்லாம இத சொல்றப்போ ரொம்ப ஓவர் சைட்டா சொல்லலாம். The way in which it works itself as an instrument itself is completely different. So that's where அது டபுளா இருக்கிற மாதிரி, it's not the case. So அது ஒரு செஷன் நம்ம பண்ணோம் ஃபர்ஸ்ட். Various options, what it is, what is the strike price, what is the premium, why it is, how we exit, all the stuff. So it's a very, in fact, we should do it for more than anything else with F&O being permitted to chartered accountants also. I think definitely it is something. There are a lot of people read youngsters na chuma abde enter பண்றாங்க actually. It is definitely a good scientific this thing. There is a huge, see, இப்போ DC கிட்ட ₹1 கோடி பணம் இருந்தா தப்பு இல்லை, because he will do lot of good things, he will make another great building for Madurai branch. நிறைய விஷயம் பண்ணுவீங்க நீங்க actually. So only money with a terrorist is wrong. So therefore definitely we can consider something on that. I just would like to run through how it works. So
as rightly says that many people become Abhimanyus who knows how to enter and don't know how to come out actually.
So we have to basically understand how the scheme works. Actually, a lot of people think that they should buy the call option. Actually, if you're a call writers are the one who always make money, not the this thing. So அந்த ஃபண்டமெண்டல்ஸ் நம்ம பண்ணிட்டு அந்த இதை இந்த டர்ன் ஓவர் எடுத்துன்னு சொல்லும் லாட் மோர் ஈஸியரா இருக்கும்னு தோன்றும். So it's a very big structure itself. In fact, there are a lot of people are not aware of the fact that if you are within that 5% range, expire aniki you have to give a compulsory delivery. So otherwise, if you do it, they will auction and you will lose a lot of money. I mean, we all think that F&O doesn't have a delivery, but though it was introduced for a different purpose, incidentally, in the F&O and the speculation loss can be set off for a period of 4 years. Assessment at 2006-07 காரணமே என்னன்னா 43(5) was amended to specifically that F&O is non-speculative. அதனால்தான் Mr. Chidambaram and Financial said, I will reduce from 8 years to 4 years, because bulk of your losses I have taken to the non-speculative. Therefore, I don't want speculative. So, incidentally, this was also introduced in F&O regulations also, 5% to this thing also. Along this thing, maybe I will be very happy to at some point of time take it up. இப்போ நம்ம ரொம்ப ஓவர்லாம் அவங்க கன்ஃபியூஸ் பண்ணாம இன்னைக்கு இப்படி தான் டர்ன் ஓவர்ல எடுக்கணுன்றதுல போயிடும். பட் இட்ஸ் a very interesting, lovely இருக்கும் ஆக்சுவலா. ஸோ 2 hours போருமான்னு தெரியல, பட் இட் will be a worthwhile one. Not only from the point of view of knowledge, at the end of the day, use the knowledge also. எனக்கு ஒரு பெரிய அட்வான்டேஜ் என்ன ஆயிடுச்சு, நான் தெரிஞ்சோ தெரியாமல இது ஆக்சுவலா நான் எஃப்எம் கிளாஸ் ரொம்ப வருஷம் எடுத்துட்டு இருந்தேன் ஆக்சுவலா. வித் டாக்ஸும் எடுத்ததுனால had the double advantage of mixing both. ஸோ ஒரு காலத்துல டி ராஜேந்தர் மாதிரி கதை திரைக்கதை யோசனம் டைரக்ஷன் மாதிரி அக்கௌண்ட்ஸ் காஸ்டிங் டாக்ஸ் எஃப்எம் டே என்னதான் விட்டு வச்ச அப்படின்ற மாதிரி கேட்பா மாதிரி. பட் அஃப்கோர்ஸ் till 2002, பட் இட்ஸ் ஆல் வண்டர்ஃபுல் டைம். ஆஃப்டர் தட் ஏதோ ஒன்னத்தை மட்டும் எடுத்துக்கணும், எதை எடுக்கிறதுன்னு தெரியும், டாஸ்க் போட்டு கட்சியில டாக்ஸை மட்டும் வச்சுப்போம் அப்படின்ற அப்போல எடுத்தோமா. இல்லைன்னா நானும் இன்கம் டேக்ஸ் டிபார்ட்மெண்ட் மாதிரி இந்த டிமேட் அக்கௌண்ட்ஸ்க்கு ஃபர்ஸ்ட் அவுட் ஃபாலோ பண்ண சொன்னாங்க. ஸோ ஐ ஸ்டார்டட் மை டீச்சிங் கேரியர் as a மேக்ஸ் டீச்சர். தட்ஸ் த ஃபர்ஸ்ட் சப்ஜெக்ட் ஐ லெஃப்ட். செகண்ட் அக்கௌண்ட்ஸ், செகண்ட் சப்ஜெக்ட். அதே மாதிரி ஃபீஃபா மெத்தட் ஆர்டர் பண்ணி கடைசி என்ன சப்ஜெக்ட் எடுத்துன்னு பார்த்தேன் டாக்ஸ். சரி அதை வச்சுக்கலாம்னு சொல்லிட்டு ஃபீஃபா மெத்தட் ஃபாலோ பண்றேன். So any other questioning we can still have, because after the program is all also Kumonathan, you go 20 question so one advantage of we are not far off, though we are distance wise, we are far off now. So we can take up the questions, madam. I'll share the presentation also, email audio also. We can take the questions offhand also. In 121 added, so I think I'm standing between their lunch and so thank you, DC, for your special appearance, actually.
Thank you very much, sir, for the wonderful session. I request Secretary CA Venkatesh to present his vote of thanks.
Good afternoon to one and all. It's my privilege to offer vote of thanks on this occasion. On behalf of MBSIRC of ICI, I extend a really sincere thanks to our speaker, CA TG Suresh sir, who spared his valuable time to address our member on taxation of securities in spite of hectic schedule. Very elaborate explanation on the above subject. Your session is very wonderful, sir. Thank you. Thank you, TG Suresh sir. It gives us immense pleasure to thank all the past SARs, to thank past SARC Chairman DC Jain, fellow members, women members, and the junior members for being here and for their effective and lively interaction on the above subject. Thank you. I also thank all Madurai branch managing committee members. Again, I thank you for being with us this evening. It's a great pleasure. Thank you, sir.
Thank you.
Thank you.